So here's the problem. Years ago, life insurance professionals would receive in-depth sales training, not only showing different life insurance products and how they work, but the advanced planning concepts that bring in the 5, 6, and 7-figure commission checks. Fast forward to today, and those types of training programs are almost non-existent. To solve the problem of inefficient marketing efforts and advisors stumbling around trying to understand how to do business in the advanced markets, Trained Advisor leads the way in showing top-level producers how to acquire, identify, present, and close advanced life insurance cases. Welcome to the weekly 10-minute concept training with Trained Advisor.
I'd like to thank you for joining me today. Today I want to talk to you about an interesting and I think an exciting topic, premium finance. Now I want to make premium finance simple because I think it really is a simple topic to understand. Honestly, I think our clients understand it a lot faster than the advisors. But if you put it in context, premium financing is really a great leverage tool for the right client. And so let's not overcomplicate it. When we get into the details of what the actual financing pieces are, some of that can get technical because it really is some technical issues. But the concept of premium financing should be fairly simple. And let me start by something we all understand. Let's go buy a house. So now we're going to buy this house. Let me put some terms. To get this house is going to be worth $1 million. Now, you've found the house. That's the house you want to buy. There's no questions there. Now let me come over to your bank account. And in this bank account, you've got $1 million. Okay? Now I'm going to ask you a question. When you go to buy this house, how are you going to pay for it? That's the question, how to pay. Now I'm going to make an assumption. I'm going to make an assumption that most everybody that's listening to me today, they are not going to use that $1 million in their bank account to buy that $1 million home. They're going to come down here and put a down payment, and then they're going to go get a mortgage for the balance. And I'm going to ask you why. Why do we do that? Because you had the money to go buy the house. Why didn't you just pay cash? Now, some people will, but most people are going to come down here and get a mortgage. There's a reason we get a mortgage. And if you look at it, it's cheap interest rates, especially today. That's number one. Number two, I don't want to tie up my money. And three, I want to leverage my assets. So if you think about this, most of us have gone through and bought a home. We understand that. And now, let me just change a couple things here. Instead of buying a home, let me come in here and say, this is a life insurance policy. Now, I'm going to put $1 million worth of premium into that life insurance policy. Now, I'm going to make another assumption to everybody that's listening. Now, when we talk this life insurance policy, most every advisor is going to say, take your money and pay the premium. Why? Why did just the change in the asset change how we're going to pay for it? Because I'm going to come back over here and just tell you, if I can go over to a bank or another lender and get you cheap interest rates, allow you not to tie up your money, and help you leverage your assets. Why would you look at this any different just because we changed the asset? And I think now you start looking at it and saying, I don't know. And I think the reason most people don't look at it the same way is because we as advisors don't present it the same way. There are lenders that will loan money on premium for life insurance policies. And it's really no different than buying a house. The pieces are the same and we get the same leverage. So if you think about it, we're going to have our insured. Insured's going to come down here and buy this policy. Now we just go to a bank, or really, I'm just going to say another lender. It's not always an outright bank, could be hedge funds, could be different lenders out there. What I'm going to do is borrow the money to pay the premium. Now, let's think about this. If this were a house, I may have to put some kind of a down payment. I'm going to have collateral, and I'm going to have a repayment schedule. All those things are going to come into this premium finance. In most premium financing in today's world, this loan from this lender is 100% collateralized. And what that means is they're going to look first at the cash surrender value, and second, you're going to have to put up collateral to protect the lender. There again, no different than buying a home. When you buy a home, the bank is 100% collateralized, either through the value of the home or the down payment that you've got to put into it. Same thing here. Our lender is going to be 100% protected. So we either need a down payment, we need collateral, and then we have a repayment schedule. We're going to pay interest, most likely annual. It's a lot of the loans in today's world, they're not going to let you capitalize that interest. You're going to have to pay it at least monthly or annually. And then we want to have a balloon payment out there. At some point, this has to end. And at some point, we want an exit strategy out of the financing. Now, I can tell you this. Death is one of the exits. When you die, the bank gets paid off first. The rest goes to whoever you've named as the beneficiary. Be careful here. I guarantee as long as our client dies at the right time, every one of these scenarios looks great. Now, I'm not going to hold our client to dying at a very specific time, so I don't want death to be the only exit strategy. We need to pay off the loan at some point in time, or have the ability to pay off the loan at some point in time, either by the cash value or other assets. So if you think about this, if I have a business owner and they know 10 years from now they're going to sell their business, we can use that as the exit strategy. So just, we want to play with that. Death is an exit, but we always want to have another exit. So at some point in time, our client knows we're going to turn the bank lending off and the policy will continue without the bank financing in place. So there again, don't overcomplicate it. When we get into the terms of our lender, that's going to get technical and a little bit complicated. But as far as the strategy and the concept, Premium finance is no different than buying a home. Instead of buying a home, we're buying a policy. We just need to make sure that policy is designed the right death benefit to make sure if we die, the loan's paid off and our client gets the money they need, that we have cash value growing in there to act as part of our collateral, and potentially using that cash value to pay off the loan. So these are typically shorter term payments, build up the cash value early, and then we work through what that exit's going to be. So we'll talk more about the different strategies here, but as an overall concept, keep the concept simple. If you need help on these, we're always here to help. Thanks for joining us today.
Hey, that was some pretty good stuff, right? Do you want to take a deeper dive into how we're leveraging social media to increase the efficiency of marketing efforts for life insurance advisors? We've been working hard behind the scenes to put together a training that gives a closer look at both the tools and strategies we're using every single day. Go to linktoelite.com and get registered so you can be the first to know once that training goes live. Again, that's link2elite.com.